You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
All right, everybody. That music means it is time once again for what the cool kids are calling OPR, a.k.a. Options Playbook Radio, a.k.a. the show for you out there. Maybe you're thinking about testing the options waters. Maybe you've done a few trades. Maybe you liked how they worked out. Maybe they didn't. You want to turn them up to 11. Maybe you're thinking about getting started and embarking upon this journey we call options trading. Either way, we got you covered. Got some offensive plays out there. You want to speculate, maybe generate some income. Got some defensive plays. Maybe you're looking at those a little harder right now given what's going on in the marketplace. Either way, we got you covered with all that and a whole bunch more. Now, if you're saying to yourself, that guy isn't usually on this show, you are correct. So allow me to introduce your usual coach in the land of all things Options Playbook Radio. He is Mr. Brian Overby, a.k.a. the senior options analyst over there at Ally Invest, a.k.a. the options guy. Mr. Overby, welcome back to your own program, sir.
Well, it's great to be back, Mark. It's been too long. It's kind of sad that we don't get to answer listener questions more often. It just doesn't happen all the time. I mean, we get so many listener questions. So it's great to hear from all the listeners, and it's also wonderful to take a little bit of time out and huddle up and answer all their questions.
It's time to huddle up and answer questions about your favorite options plays. Submit your questions via twitter.com/options, facebook.com/theoptionsinsider, or questions at theoptionsinsider.com.
All right, everybody, let's get to it. See how many of you we could squeeze on the old huddle today. Let's kick things off with Christian. Christian wants to know, what's your ideal hedging scenario right now with markets at all-time highs? This came in, obviously, not in the last couple of days. This came in a little bit before that, Brian. I wonder if he would tweak that question now. Of course, we are recording this late in the day and indeed late in the month here in October. Halloween fast approaching, the election fast approaching here in the U.S. as well. Stay tuned if you are interested. Of course, our big election night special coming up. So should be a fun one. Join us there from 6 p.m. Central to roughly whenever we end. So it could be 9, could be 10, could be later if things are popping off in your markets out there. So a little bit of a different scenario right now than maybe when this question came in a week or so ago. But interesting stuff nonetheless. Brian, I'll go first. I'll give you a chance to mull it over. I've been saying for a while that wasn't super enthusiastic about these levels in the marketplace, and I think we're seeing some of that retracement right now. Massive sell-offs in the broad markets over the last couple of sessions. So when this question came in, I was already thinking about an interesting strategy we talked about here on this show in the past. You can call it stock substitution. You can call it a number of different things, but it effectively involves maybe taking some of those positions off. Now, obviously, there might be some tax implications for that. So if you're tax limited, maybe this might not be the one for you. But taking off, let's say, your SPY positions, you could take off some or all, depending on your level of comfort out there, and replacing those with some call options. You can go a bunch of different ways. You can go in the money, get a little bit deeper if you want a little bit more of a direct stock substitution, delta type substitution. If you're not as comfortable, you're putting this trade on, you're probably not as comfortable. Maybe you want to go a little bit out of the money instead. What does that do now? That allows you to keep most of your assets safe and secure in cash. And then if something happens, if you're wrong with your outlook, if the market has yet another aggressive V-shaped turn to the upside, you can play. You can participate with those upside calls. You can also do verticals if you want to limit your outlay. There's a lot of different ways you can approach this, but this is a way to have a seat at the table, still be able to participate, but also not lose the house, not lose the college fund out there. And also, it's not just straightforward going out and gobbling up puts, which we know are pretty expensive now. Obviously, if you're going to sell stock and then buy calls, so you're synthetically doing something very similar out there, but at least you're playing in the call wing where the implied volatility levels are much more reasonable than they are if you look at, let's say, your traditional 5% out of the money puts in. Pick your index of choice right now. They're all pretty rich. All right, Brian, I kicked things off for you. This is an interesting question. I'm sure one you're getting a lot over there at Ally right now. What is your ideal hedging scenario out there?
Well, to piggyback on your comments a little bit, I mean, yes, and that actually works better when you're talking about an underlying like the SPY, one of the most liquid underlyings out there. So if you go out further in time, you go deeper in the money, the SPY still has a really good market. So, the concept would be I'm going to sell a portion of my portfolios and I'm going to replace it with SPY call options, which a lot of people don't think of that as an actual hedge. But when you buy a call, you're limiting your risk. You're limiting your downside. And it's actually a surrogate. If you're buying an in-the-money call, that's a surrogate. It's synthetically the same as owning a stock and buying an out-of-the-money protected put on it. If the strikes are the same, it's basically that same type of trade. So I do like that you mentioned that, and specifically because of the SPYs. Now, if you have underlying stocks that aren't as liquid, it's a little bit tougher to say, well, I'm just going to sell this stock and I'm going to buy deeper in the money calls going out further in time on them. And then the biggest thing is just the bid-ask spread. So each and every underlying has its own trials and tribulations as far as bid-ask spreads are concerned. But I do like, without a doubt, Mark, especially if you just want to try to make it simple, stupid, if you will, let's just stay in an index that's very liquid and sell some of our stocks, generate some cash. And how do we protect ourselves against an upward movement of the marketplace? Well, let's just buy some calls, either in the money or out of the money, depending on which way you want to go with it and how much risk you really want to have out there. Okay, so now on my ideal hedging scenario, I think when you're in the scenario, one of the things is stocks that you've made a good run up since the March lows, and they've done pretty well. I would ideally like to buy some puts in them, but they're really too expensive, especially after the move in the marketplace today. So I do like looking at collars, and just be aware that, yeah, if I do a collar and the market does go up, that means I own 100 shares of that stock and I own a protective out of the money put, and then I sell a call to pay for it. If I'm doing that scenario, that I might actually get my stock called away. But unfortunately, with the price of the puts nowadays, it's really hard to actually just buy a put outright. So the other alternative, so basically I guess I'm going away from buying puts outright. I want to sell something in this marketplace. So if I'm not collaring it, I would at least look to do a bear put spread, where I'm buying that put that I want for protection, but I'm going even further down, 5, maybe 10%, because I can still get something for those puts. And I'm selling a put that's going to limit my potential insurance policy to the width between the strikes. But it's at this point in time with where markets are at and the VIX spiking, I don't know exactly where it's going to be at when the show is out, so I won't quote a number overall. But in those scenarios, I think you need to look at protection strategies where you are bringing in some type of capital by selling option contracts, as opposed to going to the call side, as Mark said, a little bit less volatility, just an interesting other way to approach it. And I really do like Mark's plan. I think Mark wins this one. If this was a polling question, I think Mark's answer was better than mine.
Ooh, I win. Let's keep going then before the judges can change their mind. No challenges allowed here on this play. I like that. All right, next up we've got Dan. Dan wants to know, I have a question about trading options on HTB. I'm assuming he means hard to borrow stocks. How do they assign short shares? You said that 5 times fast. Assign short shares to the buyers of put options if it is hard to borrow. All right, a lot to unpack here, Brian, on this one. It sounds like he may be conflating a few things with what puts are and what they actually bring to the table. So maybe set Mr. Dan straight here on what puts actually give you and how they work in these hard to borrow scenarios.
Well, if you are buying a put and it is a hard to borrow scenario, it does a lot of times, it inflates put prices relative to call prices on that same strike line. So if I do buy a put and I were to exercise that put, that means that I would get short stock. So I'm the buyer, I'm in control, so I exercise, I sell stock short. Most of the time, if you're dealing with hard to borrow stocks and you're a buyer of a put, you really want to just close it out and sell it because there's a lot of headaches if you exercise and get short that stock because you're right, they're hard to borrow. So if you did exercise and got short puts, they might call you in on the short stock the next day. You might actually get that stock, allow yourself to be short, and then you get called in by your brokerage firm because they need the shares. There's a lot of headaches that are involved with being short stocks, especially hard to borrow stocks overall. So it isn't for the faint of heart to be buying put options or selling put options in hard to borrow stocks because of the problems that it does create, in that the underlying shares are just not available to short.
Yeah, that's the nice thing about puts there, Dan, is that once you buy them, you have a contract in your hand. That contract allows you to do certain things, including for the lifetime of that option, sell that underlying at that price. So that's what's nice. There's no allocation you have to worry about, anything like that you have to deal with in the stock side. Now, so that's the nice thing about buying puts. The downside is people know that. This is not a secret out there, which is what Dan is you, which is what Brian was alluding to there earlier, is that people, when these hard to borrow names, are going to start bidding up these puts for that precise reason. They can't really get short the stock without going through onerous and very expensive means to try to borrow it, so they're going to buy the puts. And as a result, the puts get more expensive and more expensive. You're going to see that lack of liquidity in the short selling be reflected in the price of those puts. Remember, at the end of the day, market makers, they're not magicians. They can't manufacture liquidity where none exists. So if they can't borrow the stock to hedge against all the puts that they're selling you, they're going to reflect that in the markets out there. So it's going to be expensive. That's the downside. But the upside, the upfront, really clear part of options, you have a contract. If you buy it, whatever the price may be, it could be expensive. Once you've bought that, you have that right throughout the life of that option to exercise it and sell it at that strike price, regardless of whatever else is going on out there. There is no assigning to you or no lottery or picking or anything like that. You can exercise it and sell the maximum amount of contracts you are allowed there according to that option. So that's the nice thing about it. The downside, it's going to be expensive as a result. All right, next up we've got Scott Somer. That name sounds familiar. He's a frequent listener and chimer-inner. He loves our shows there on YouTube. If you're one of the growing number of people who likes to check out our content over there on YouTube, have at it. Like we said, it's not really designed for video consumption, but we jazz it up with a fun little image for you to watch over there. It's really like we know, most of YouTube's use case is really primarily listening anyway, so we oblige you guys out there, and a lot of folks seem to be enjoying it, so head on over there. We've even created some fun little playlists that allow you to choose things by different subject matter. We need to go in and expand on that even further. We can probably go a lot deeper with that, but for now, we make all the shows available out there. It's a good starting point. Scott wants to know, how about doing an options playbook radio or maybe a boot camp, that's our other educational show, on the proper, in all caps, the proper day to set up on a bullish risk reversal? I'm not sure what he's going for here, Brian. The proper day, Tuesday. I think Tuesday is the best day to do a bullish risk reversal. What do you think, Brian? Or maybe Wednesday.
I like Tuesday because I have that little Tuesday lottery song. So Tuesday sounds good, I guess. No, overall, I kind of understand the question. I see what he's going with here. A bullish risk reversal, I'm assuming that we are selling a call and buying two calls, just like we talked about on one of our shows recently for the earnings. And is that correct? Is that what you consider that on boot camp?
Yeah, that could be. Go for it.
Okay. So when you say proper day, I'm assuming you're addressing the time decay factors of it, because when you're selling one option contract and you're buying another option contract, time, when you are incorrect, time value is your friend in those scenarios. In other words, if the market is not moving enough to make your trade profitable, as time decays and it withers away from your strategy. Now, there's a lot to go around this because, you kind of need strike prices, Mark, to be honest. If you are incorrect, you will lose money. The maximum to actually lose on that strategy is really just right at expiration, because you're going to be long two option contracts and short another option contract overall. So the long option contracts, if the stock stops right at that strike price, that's where your biggest risk is. You don't want it to settle right at that strike price at that expiration. So time value helps you. So when you say the proper day, I guess I'm looking at, if I can do them, I want time. So the proper day for me to do it would be as far out as I can and still get it done for a net credit to the account, ideally, because you could do it on this trade in particular, or a smaller net debit. But knowing that time is what you want, because you want a movement in the underlying stock, and having more time is better than less time, I would say I want to go out as far out as I can and still get the net debit or net credit that I am searching for overall. I hope I got that right.
I'm going to stick with my answer of Tuesday. I think clearly you do all bullish risk reversals on Tuesday. Any other day of the week, it's just a fool's errand out there. An interesting question, Scott. Let us know if that's what you were actually going for, or if you had something else in mind. Remember, with these questions, I don't want to encourage epic treatises, because we do get those all the time too, but a little more detail can sometimes help us intuit what it is you're actually after. All right, next up we've got Mella. Mella wants to know which, this is a subjective question here, which is the most important Greek? Well, a lot of ways you can carve this up. I've said it in the past that the traditional audience for this program, the basic retail options trader, I think they're far too concerned and far too fixated on delta. And it's understandable. It's understandable because they're coming from the stock world, and the stock world is all about delta. It's all about directional movement. When you get into options, you have these other Greeks that start coming into play. You have theta, you have gamma, you have vega, and your basic retail options trader doesn't really spend enough time worrying about particularly gamma and vega, the latter two. They usually start to grok pretty quickly about theta because they like to probably start discovering the joys of selling options, and theta becomes their friend as a result. So, or maybe they buy some options and theta hurts them. So they start to understand theta pretty quickly, but they forget those other two, which are gamma and indeed vega. So I'm going to go out there on a limb and say, because there's no most important. That's really highly subjective, and it depends what your strategy is and what you're going for. But I would like to see more listeners of this show spending more time understanding the vega of their positions, where their volatility falls in relation to, let's say, historical, doing some basic analysis of that as well. What level of implied volatility are they trading? What is the overall vega of their option? How much vol bang for their buck are they getting on that trade? And then also gamma, another one that's very confusing. I get it. It's effectively relating back to another one of the Greeks, which makes it difficult. But if you're going to focus on delta and you don't understand gamma, then that's challenging. And of course, gamma and theta are two sides of the same coin. So if you're going to do a lot of income trading and you don't understand gamma, you're also going to be very confused by it. So Brian, I kind of cheated. I said kind of more of the above. But I definitely think for a lot of the audience of this program, maybe migrating their gaze away from just being fixated on delta and maybe looking at some of the other Greeks and understanding how they all interplay probably wouldn't be a bad thing. Would you concur, sir?
I do. And I do have a couple of comments just in general about your favorite Greek. I want to take it to a different level, and I actually would like to think of it as a relationship more so than a Greek. And I think one of the best relationships to understand is the relationship of gamma to theta. That's acceleration versus time decay. And I do talk about this a lot on Options Playbook Radio, specifically around earnings, because for example, Apple is going to, or not Apple, let's say the bigger one, the Amazon is going to be announcing earnings soon. And I don't know exactly when we're going to be putting this show out, but Amazon has a tendency to announce earnings on Thursdays after the market close. And I find that very interesting because for some reason they always decide to do it on a Thursday, and a lot of firms don't necessarily pick the same day of the week all the time, but Amazon seems to. And that means that our one-day weekly option contract only has one day to live, and that's the Friday after the Thursday. So a lot happens there in that you have this very expensive underlying, and that pumps up the actual price of the option contracts. And we'll talk about a little bit out of the money option contracts. So you're obviously going to have a huge rate of theta decay, but then the option contracts are going away. So if the options get in the money, you also have a lot of acceleration. If an out-of-the-money option contract gets in the money, it starts moving quickly either with you or against you, and vice versa. If you have an in-the-money option contract and it goes out of the money, it slows down. So it's an interesting scenario. So I think the relationship between gamma and theta, and a lot of times I've actually seen it quoted in pricing models where they'll actually throw in and they'll call the variable epsilon or some other Greek letter, and they will actually look at the ratio of gamma, the acceleration, relative to theta. So I agree with you about delta. A lot of people look at delta, but to me, it's more important to understand how the Greeks interact with each other. And Amazon is definitely, after earnings, is a real interesting test case to see how options react relative to having this big event that pumps up all this implied volatility. And then on that Friday, all those option contracts, the time value in them, no matter if they're in or out of the money, have to go to zero. So
I like it, sir. It also opens the door for potentially discussing crazy things like second-order Greeks down the road, sir. What do you say?
Yeah, well, true. I mean, the Greeks it's a mathematical formula. The only reason why gamma exists is because everybody likes delta, as you mentioned about, and that's just the derivative of delta is gamma, and that's the rate of change of delta. So you could have a rate of change of theta. You could have a rate of change of alpha, which is actually gamma versus theta. You can really go down a big rabbit hole once you get going.
The dark rabbit hole that is second-order Greeks. We're also down a dark rabbit hole when it comes to questions here, Brian. We're kind of coming up against it, but I think we have time for one more. So since this is your show, sir, I will allow you to choose where we finish up. We have a litany of questions before us. Which one tickles your fancy, sir?
All right. Let's try this one. This is from MLS. I think the market is going bearish for the next few weeks. Is it better for me to buy puts or sell calls in the money, out of the money, at the money? What expiration would you like to trade? Should I close the position before expiration if it hits my target? So, yeah, that's a short one. I say kiddingly. But obviously, I just find that interesting because, yes, I think people are thinking about puts, and that's very obvious that we are. And the reason why I say that's obvious is because the VIX cannot get below 25%. It's really struggled. Even when the market was setting new highs, we still saw the VIX in that range. And to me, that means that a lot of people are actually using options as, like you mentioned, Mark, at the top of the show. You look at the S&P 500 index and you look at put options out of the money, and the premium is just huge. The skew to the puts are very large at this point in time. And to me, that means that there's a lot of institutional traders, more so than retail, that are using that SPX index as a way to protect or hedge their positions. So if I'm buying these puts and I'm doing it in a very volatile marketplace, I really want to think about bear put spreads. I want to think about buying a put and then selling some premium against it. We addressed it a little bit on the show earlier when I was talking about puts and talking about collars. But if I do a long put spread overall, if I do it, I do want to pick my expiration wisely, though, because if I am just trying to be bearish on the marketplace, I don't want to go out too far in time, mainly because if I'm correct on my forecast, a put spread maxes out closer to the expiration date than it does if your forecast is correct, right? Closer to the expiration date, because you're selling an option contract that wants the market to go up and you're buying an option contract that goes down. Now, they're fighting against each other, and the more expensive option contract that you buy will usually win the fight overall if you're correct on your forecast. But in general, if I was going to be looking at getting bearish, I would be thinking bear put spreads overall versus buying calls, selling calls, in, at, or out of the money. And that even allows me to go a little bit out of the money on my put spreads, too. I don't mind that. It really depends on how bearish you are.
All right. Well said, Brian. That's hard to argue with that. I mean, at the end of the day, if the stock's going to drop, you think it's going to crater, you're definitely going to be better off buying yourself some puts or indeed some put spreads than just selling a call. Remember, you're selling a call, that's a finite return, whereas the put gives you much more potential for upside on the downside. All right, that music means we've come to the end of this fun Huddle Up episode. I want to thank all of you out there who wrote in with questions. Remember, keep hitting us up. Maybe Brian and I will get a chance to get back together here in the Huddle more frequently, because we do have a lot of questions. And these are troubled times. We get it. You guys have a lot of questions. Keep hitting us up. If for some reason we can't get to them on the Huddle fast enough, we'll make sure we get to them on other shows as well. So you won't be waiting too long out there. Keep those questions coming. And Brian, if folks have a question for the show, or maybe they can't wait till our next Huddle, they want to reach out to you directly in the interim, sir, where should they go? What should they do?
Well, I'm getting a lot more active on Twitter, and that handle is at Brian Overby, just my name. But you can also email me at theoptionsguy@invest.ally.com. I want to say thanks for helping me host this week, Mark, and thanks for listening, all you listeners, and keep sending the questions in. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money, and all the ones you've sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.